Thank you, Rana. It's now my pleasure to welcome the Copper panel, moderated by Dr. Nicole Adshead-Bell of Cupel Advisory.
Well, I think after that rousing music, we hope we have just a rousing panel as well. I'd like to thank you all. This is the hardy crowd that have stayed to the last day. We'll endeavour to keep it as exciting and entertaining as possible. So today we're here to talk about copper. And I have my esteemed panellists to help me with these discussions. And from my perspective, copper is the critical mineral. It's the foundation of the global energy transition, and yet despite the fact that we're seeing, which will start this year, and everybody agrees on this, a material decline in primary copper price, we are yet to see the underlying copper price increase to the levels that it needs to be to incentivise new production. So today we're going to discuss as to why this is, and I'd like to introduce my panel. So starting from my left, we have Dawn Wellman, who's the manager, hopefully I've got your title right, manager of research and development of Rio Tinto. So we've got the big boys in the room. Next to Dawn, we have Mast, president and managing director of Cygnus Metals, with their, I'm going to massacre the pronunciation of this, but their Chibugamu? Chibago? I'll blame it on my accent. Copper gold project and lithium exposure in the province that we're in today, in Quebec. Next to Ernie, we have John Deluce, who's president and CEO of Abitibi Metals, with their high-grade B26 copper, gold, zinc, and silver deposit, also in Quebec. And to round out the panel, we have Sam Lee, who is president and CEO of NorthIsle Copper and Gold, and with their North Island Copper Gold Development Project in BC. So to start off, I think, as I said at the start, that the copper cycle has been shaped by supply constraints rather than demand growth. So starting off with you, Ernie, from your perspective, where do you think we are in the cycle and what needs to shift before we see meaningful new copper supply coming online?
So a couple of things have to happen for new copper supply to come into production. A key one is the long-term copper price predictions. A lot of people are talking about $5 copper price as the incentive price in order for people to build projects. And not all projects require such a high price, but the majority of them do as the projects are getting bigger and riskier as we go forward. And of course, another issue which is quite important is the permitting regimes. Jonathon and I are fortunate enough to be in the province of Quebec, and as we move our projects forward, the province of Quebec has a very challenging, but call it quantifiable process for getting your permit. You know what you have to do, and you just have to go and do it. And there's very little uncertainty in the province of Quebec moving your project forward. And Quebec is not, or Canada is not, a litigious society. And so once you get your permit, it's pretty well a green light to go ahead. But we don't see that all over the world. And that's a really major problem for the copper industry in terms of getting the supply into the market.
Yes, with the average timelines from discovery to production now being in excess of 20 years. And permitting is a big part of the process. That's part of the challenge. So John, you're also in Quebec, so be interested in your thoughts.
Yeah, I think Quebec is certainly a great place to do business, and stepping back, we're at a real inflection point with the supply-demand imbalances now accelerating over the next 5 years. So it's not an easy equation to fix, because higher copper prices, we just can't throw money at this. As you said, the timeline from discovery through to production is so significant, at a time that there's been such an underinvestment in exploration, in production profiles. So it's not an easy equation to fix, but I think the demand, higher prices help fix some of these issues with investment. But I think as well, we're starting to see political issues that are affecting supply. In terms of like 50% of copper supply worldwide coming from countries of political instability. So it's about what factors can increase supply. It's not an easy fix. And what risks is there to current supply? So there's a tough balance that we need to look at. But again, another reason why we're thankful to be in such a good jurisdiction.
And rounding out a big copper producing province, Sam?
Oh, that you're absolutely right. BC was once Canada's largest copper producing province and potentially a region in the world. This happened, in the 60s and 70s. And we did see this migration outside of Canada to other very, very robust jurisdictions geologically, Chile, Peru, South America, Africa, because you could sanction projects quickly. And that was quite frankly, the regressive nature that Canada had faced is it became almost a pariah state or a pariah region because it took so long to effectively establish the will and consents of the people, the social license. And so fast forward to today, or perhaps even 5 years ago, we're starting to see a little bit of uncertainty in these other regions whereby this political instabilities or the lack of social license has created a little bit of quite a bit of supply disruption. And so we're seeing this regression coming back into Canada, coming back into BC for established protocol, for established permittings. And as one of the panel members said, it's you've got the assurance. Once you have the permits, you've got the assurance that you have authority to move the mine forward. So I have always said I'd rather spend tens of millions of dollars figuring out whether something is permittable versus billions of dollars than having it effectively expropriated from me. So it's a very positive environment that we're shifting towards. It's not perfect, but it's certainly matching the rhetoric with action. I'm quite encouraged with what we're seeing in BC and the rest of Canada.
And Dawn, as a representative of Rio Tinto, so one of the largest diversified mining companies in the world, and I think the general investing public and corporates look to the larger companies as in terms of what they're thinking as that can lead enthusiasm or lack thereof for particular commodities. And so what is Rio thinking, as much as you can talk about it, in terms of when would be the right time in the cycle to either make decisions on deploying capital, whether it's from an M&A or advancing development decisions on existing projects?
Yeah, and it's really tough, right? Because the time that we're seeing in terms of when the supply and the demand isn't necessarily lining up with the time frame that we all need to be able to make those decisions. When do we start to, work to bring a mine online, like you said, 15 to 20 years? When do we start to make those capital changes? So, we look at all of the same factors that my co-panelists were just talking about, as well as things like, obviously forecasts and trends in that, but also just looking at kind of the global dynamics and the geopolitics of the situation. And as you started off the session, a lot of what's driving the drive in other sectors right now, which is causing the demand for copper, is being driven by climate change. And we're evolving from a technological perspective very, very quickly in new spaces, clean tech, AI, those types of things, all of which are increasing the demand for copper in particular. The challenge is the pace. The pace at which that demand is occurring and the pace at which it is aligning or not for us to actually bring those online, because like we're saying, we're not actually seeing the signals yet, but it's because right now we have a bit of capacity within the supply, and so at some point that capacity is going to be exceeded, and then we're going to get a really strong demand signal, and we still have the runways that we have in order to be able to get that ramp up in production. So it's a really difficult balancing that we all have to work through.
And oftentimes, I think because you have such an inelastic response to immediately price pressure, so you tend to get these very big swings in terms of capital deployment in the system.
Agreed.
So John, Abitibi is advancing its high-grade B26 deposit, and you have a fully funded 20,000-metre drill program, a strong balance sheet, and so you're aimed at resource expansion and new discoveries in 2025. It'd be great to understand your experiences of working in Quebec in terms of the regulatory environment and the permitting regime, and how you found that in terms of an ease of doing business.
It's been excellent, and it's when trusted with family capital, we wanted a jurisdiction that we knew if we had success, it's a risky business, that we would be reflected alongside our shareholders. We had a bad experience in another jurisdiction where we made a discovery, but then we couldn't permit it. So all our efforts were in vain, but at the end of the day, Quebec has, in terms of where we're at, earlier stage, the drill permit process, ATI process, consultation process is very straightforward. We're turning around permits on a 45-day basis, faster in our case because we are actively engaging with our First Nations and municipality partners. So there is a clear framework within the permitting sector, and we also have so much support from the government. We have Quebec institutional funds that have really been the lifeblood of the junior mining sector through this tough market conditions. We have larger funds like Investment Quebec, Case de Depot that are there for larger infrastructure projects. So really it's a very well supported province, and not all provinces are equal in Canada. So I think it really sets a competitive advantage and really removes some risk from what is quite a risky junior mining business.
Absolutely, and I'm curious, obviously your present CEO and your family officer is a very sizable shareholder. We live in an industry where capital is scarce, particularly at the junior end of the scale, and I'm sure there were many opportunities that you could have focused your attention. What about Abitibi focused you?
Yeah, I think really from our view, we're not perma copper, we're not perma gold, precious metals, bulls, but we see a significant opportunity over the next 5 to 10 years. So we're also taking capital out of industries like real estate that we felt were quite overvalued in the Canadian markets. But really, we wanted more exposure in critical metals and precious metals. And really at a time in the junior mining space that we feel that there's a lack of prudent management of capital. So I think we need to do a better job in making people money and having a better return and efficiency on our capital allocation. So that was part of what drove us after 25 years in the private mining markets to step in and have a flagship company for my family office. So it's a big part of the opportunity and finding an asset that we could really build a real company and team around. But again, the opportunity that's here.
Thank you. Ernest, Cygnus is advancing late-stage exploration assets, also including Quebec. And I think what's an interesting thing to point on is we have these discussions around jurisdictional risk, and that we have Canada and Australia and the States that are perceived to be low risk, but risk really manifests itself in different ways. And I think you made a point, John, earlier about you're in one jurisdiction and then permitting became a challenge. And so interested in your observations too, as someone who's worked around Canada, or your experiences in Quebec in terms of your ease of doing business, and just talk a little bit about your strategy and forecast news flow for this year in terms of what you're hoping to achieve your exploration programs.
Sure. Our project in Chibougamau, which is a 5.5-hour drive from here, location to the northwest. It's a town which is a mining town. 7,500 people, started as a mining town in the 1950s, and there's been 17 past producing mines in the area. And we're looking at a restart of the mining camp. Our project's probably the lowest capital intensity project in the copper world. And we're at a point now where we've done a PEA, or a preliminary economic assessment, but at the same time, with the merger of two companies, Doré Copper and Cygnus Metals, we've put a refocus on exploration, and we are currently testing a lot of the targets which at the Doré level we just did not have the scope to look at everything. We've done a massive amount of document scanning, over 120,000 documents. We're doing compilation of all those documents and generating new drill targets, and we're going to have some pretty interesting news coming up. So our main news flow will be on the exploration side of deposits which we currently do not have a resource. So we're going to be issuing new resources on a couple of our deposits. We're a copper gold project, and right now in our PEA, 85% of the value is copper, 15% of the value is gold. However, a couple of the deposits we're working on currently, the ratio is almost flipped.
Right.
And so that gets us back to the historical camp, which produced about 3.2 million ounces of gold and 1 million tons of copper, is really a 50-50 copper gold camp. And so that situates us really well with the current environment for copper prices and gold prices. And so just getting back to your question, the work that we're doing is a combination of exploration drilling at some of these deposits which we have in our sites, but also we're continuing to do infill deposit at our flagship Corner Bay deposit. We currently have 8.6 million tons at about 3.4% copper, making it arguably the highest grade copper deposit in North America. We're infilling that deposit now, and the infill work is going really well. But in today's current capital market, if you announce a 3 meter at 4% copper intercept, which fits in really well with your current model, it really doesn't move the needle. So we're countering that with kind of the more interesting exploration results.
So is it fair to say that investors or potential investors are responding more to the exploration excitement versus the true economic aspects of a development project?
Yes, definitely. And at one point, the company will make a decision where we're going to say, we're all in now for the feasibility study and getting to a final investment decision where we can translate the value in the ground into a project which would be a free cash flowing business. And at current copper and gold prices, all of our projects on paper look fabulous.
They do.
And
Yep.
the issue is the capital markets are not recognizing that. So our share prices are relatively depressed, and it's challenging for us to raise the money at the rate we need to accelerate. And that gets back to Don's initial point that we've got this disconnect where the world wants all this copper for data centers, for electric vehicles, for electrification, and the three gentlemen here, including myself, we're trying to satisfy that need, but our hands are tied because we just cannot go fast enough because we're limited by the capital markets, and governments do step in, such as Quebec, and we really applaud Quebec for doing that.
Sam, with NorthIsle, NorthIsle has absolutely broken the trend of the Lassonde trough. You released a PA earlier this year, and not only has your share price not gone down, which is what usually happens, it's gone up, and you've had incredible share price performance. And so it'd be great to hear your perspective on what's resonated with investors about the story, and also just touch on your experience in BC as a jurisdiction with respect to the ease of advancing permitting and maybe some of the complications that have happened more recently around the jurisdictional side.
Sure, and you're absolutely right. The answer to the question is that simply we're second to none on the most important metrics that people care about from an economics perspective. The PEA is not an ordinary PEA, it is quite an extraordinary PEA. At analyst consensus pricing, not at spot pricing, so that's $21.50 gold, $4.20 copper price long term. This yields a $2 billion after-tax NPV with a 29-year mine life, a 29% after-tax IRR, and a 1.9-year payback. So think about this, a $2 billion NPV project with a 1.9-year payback. It's got a 1.7 times NPV after tax to CapEx. So when we talk about capital intensity, it's the question of, is the amount of NPV, is the breadth of the project good enough, strong enough to substantiate the CapEx that you're spending? We are second to none on that ratio. In addition to that, when you see a 29-year project, you very rarely, if ever, see an IRR after tax of 29%. The longer the mine life, the smaller the IRRs. That's just the nature of the model. That's why small 8 to 10-year gold projects usually have 30 plus IRRs, but 30-year plus projects usually have about 15 to 20% IRRs. So from every single metric, from a capital intensity, from a return, from a materiality perspective, this project is second to none. You will not see another project that's defined. That's why the market is getting excited about this. And then coupled to your second question around BC, so how do you then take this this project parameter and execute it into a vision, that vision into reality? Well, if you look at our board, we are stacked with two mining Hall of Famers, Dale Corman and Alex Davidson, who just joined our board. We have an individual, Kevin O'Kane, he's worked out over 35 years at BHP. He built Escondida, which is the largest gold copper project in the world today. And then we have Martino Di Ciccio, who's the president and CEO of Montage, someone who's building a gold project in Cote d'Ivoire. So this is a leadership group that is entirely aspirational, but has all the experience to execute those aspirational goals. And what we have decided collectively as a group is that because of the political environment in British Columbia and in Canada, where we are now seeing 18 projects that have been high priority projects by the BC government, critical metal projects, we are one of those 18, and now have seen 4 projects that have been publicly expedited. Our objective is to be in the next announcement, the NDP announcement, around projects that are going to be expedited. So for that, that's quite a Herculean task, but based on the leadership of our team and our experience and our proven ability to make money for our shareholders and to do right by our stakeholders and landholders, we are very confident we will achieve this.
That's great. So I want to just move on to, we're going down towards the end in terms of time availability, but a topic that's near and dear to my heart, and M&A and strategic consolidation. And I think typically you tend to see very predictable behaviour depending on where you are in the cycle. And so we live in an environment where I think you've heard with the 3 smaller companies here that all have assets that have very material strengths and should be advanced, but we're in a capital constrained environment. And so as we look at this, the thing that I ask myself is majors, I'd be interested in your thoughts on this, Dawn, is majors tend to acquire when prices are escalating. I would say most large companies don't tend to be contrarian investors, and so sometimes that can be a symptom of almost of being at the top. And so in our industry, smaller companies, one business plan is obviously that you aim to be taken out by a mid-tier or a large-sized company. But also there's an opportunity, I think, for smaller companies to get together and basically form a super junior, and your marketing pitch would be, well, we're going to control all future supply. And if you want access to that major company, then you're going to have to come and pay up. And so, Dawn, from Rio Tinto's perspective, what attributes do you think are key when you're evaluating copper projects, potentially either for partnerships or for acquisition? What do you focus on most? Is it size? Is it scale? Is it jurisdictional risk? Is it permitting timelines? Is it grade? Is it ESG credentials?
Yes. I mean, all of those things get factored into it. I mean,
Right.
we look at every one of them kind of on a case-by-case basis. We have a strategy. The opportunity has to fit within that strategy in some way, shape, or form. It has to align with our values. It has to align with our business objectives. And so we look at all of those factors.
Right.
In no particular order. I mean, they all factor into it.
It seems to me too that a lot of larger companies are outsourcing their exploration, and they're outsourcing it to the juniors, but the challenge to that, in my opinion, is that juniors need to constantly be raising money, and shareholders react to drill results. And so this very long-term commitment to train scale exploration that I would argue the majors did in a much more proactive way in the 1990s. It seems to be less of that now. So what are your thoughts on?
I think it's both. I mean, for us, we do have in-house exploration, but we do also look at juniors as well. I mean, they're a very important part of the equation as well. So for us, it's a bit of a mix.
Right.
And my opinion, but I think that's healthy. I mean, I think we do need to have some of that in-house expertise so that you're constantly, fitting within that strategy. You're constantly working on that strategy, moving things forward, doing that in-house exploration, not just relying on what's coming forward from the juniors. So I think both is kind of the right mix.
Right. So I'm going to open up to the 3 of you, and you can all jump in. But again, despite record high gold prices, very strong copper price environment, we're yet to see the share price love flow down into the junior sector. Capital is still scarce, it's hard to access. And so how do you navigate this world where there's a propensity and a desire to drive your project forward, but in doing so you may not get rewarded for the market? And so how are you thinking about that as each of you running your companies? Ernie?
In our case, we did a merger with an Australian firm to get listed on the ASX, and we're dual listed. And one of the reasons for us wanting to do that is we felt that on the ASX, we were rewarded with a re-rate on our project, and it did occur. Our project maybe tripled in value, market cap, because of that re-rate. So that's one of the things we did. And being on the ASX also gave us access to a different pool of capital.
Yeah.
But one of the more important things is the Cygnus company is part of a kind of a loosely knit group And they have very good street credibility in Australia, and so that gave us access to other capital. So that's how we responded to the value trap that we were in at the time.
Oh yeah, we used to see Australian companies coming to Canada for the re-rate, and now it's the reverse. So yes, I think everybody forgets that there's this huge pool of capital with superannuation funds in Australia. So John?
That's a great point. The ASX in history has led the Canadian markets. Hopefully we're there once again. But I think from our perspective, the key thing is staying well ahead of capital and tapping in. There's not a lot of institutional capital around for the small cap space, but there's some very targeted funds that have a long view on copper, especially copper gold deposits that are there. You got to build the relationships with them and get in front of them. But switching for a second, part of what excites us is the fact that traditional gold miners are now getting very aggressive in the primary copper space. So we are opening up the potential suitors of success at Abitibi as to, okay, who are our potential partners down the road? Not just traditional base metals producers anymore. We have examples this year of traditional gold miners investing across the copper space. So it's a great sign of flows of capital. The majors are performing extremely well on a cash flow basis. Eventually, after neglecting exploration for quite a while, it's going to trickle down into what is few quality development opportunities in the junior sector.
Yeah, I mean, some of the gold companies have probably, their marketing has been, I want to be a copper company when I grow up. Not sure that that's actually going to happen, but I think the attraction to that sector is very long duration assets. And Sam, you have a very long duration asset at 29 years. The average gold mine lasts 10 years, and obviously there's resource and reserve replacement, but maybe you could just touch on your thoughts as well.
Yeah, sure. Maybe I'll address that first because it's a really interesting segue into it. So I know that this crowd, I'm sure, knows Dr. Norm Keevil, Chairman Emeritus at Teck. He wrote a book called Never Rest on Your Oars. And in that book, he actually describes how Kamenko evolved, right? And it actually evolved through gold. It was Hemlo. It was these very high-yielding gold projects that effectively helped facilitate the growth of this massive base metal copper conglomerate. Well, that's exactly our strategy. That's exactly how our PEA is configured. It's effectively a gold project. It's 70% by revenue gold that has the higher margins, 65%, 70% EBITDA margins upfront in the first 6 years, and then bridges into the much larger gold copper proposition that gets you that 29 years. And you're seeing this variation on a theme just expand through the industry with pretty much every single gold company looking to establish some copper exposure because the merits of copper is that it has so much longevity. It has breadth, it has 30, 40, 50, 100-year mine lives. This is sustainable. This is the definition of sustainability. And so if you have gold, which is, in my mind, copper is the critical commodity, well, gold is the critical currency. Right? And if you have that critical currency, you could contract your cost of capital, you trade at a premium, you're able to access capital more fluidly to effectively bridge to that longer term proposition. My background is investment banking, and for decades we were always wondering what it would take to get the generalist investor to invest in our industry. Well, it's copper. It is copper because it's relevant, it's big, it's substantial, it's investable, and it progresses to a narrative and a direction that the world is going towards. You have to solve a problem always, and the problem in this world is electrification. How do we substantiate this need for energy? It's through electrification, and copper is king. So that's my comment on the copper gold aspect of it. But I also want to encourage people that what we're seeing today, right now, is actually terminology in investment banking. When the ducks quack, feed them. We've now seen 4 very significant deals in the market. Today was just announced a Firefly deal, which is an ASX, TSX listed company, and the significant portion came from Australia. It was over $50 million, from what I understand, is doing quite well. We had Arizona Sonoran just raise another $40 million that essentially was driven by a 20 million lead order. So that's about $130 million they've raised for a copper developer, early stage, PEA stage project over the course of the last year and a half with a strategic 9.9 investment. So it segues nicely into my final comment, which is the answer to your question finally. The answer is through partnerships. Whether your partnership is established through institutions, and in our case at NorthIsle Copper and Gold, we have over $5 billion institutions that are in our story, that support us, sticky money, long term. They put it into the illiquid funds. They're not going to sell. Franklin Templeton is our lead institutional investor. Whether it's partnerships through strategic cornerstone investors like Michael Gentile or Donald K. Johnson or our chairman at 10%, or insiders, we own over 20% of the stock. Whether it's through consortium groups, and I'll just, because of recency effect, I'll reference the Nico Eagle deal, or sorry, excuse me, the Foran deal, where they bumped up against a $350 million capital overrun for, I'd say, a very critical project for Canada, right? This is the newest copper mine that is being developed today.
And Sam, we're running a bit over time, and we have our next speaker. Two seconds.
Partnerships. That consortium bid brings a brand that establishes a base, that establishes a safety net, that is able to support the risks that are inherent with mining.
Couldn't have said it better myself. So apologies for running slightly over time. We have a great panel. Please reach out to them if you have any further questions. Thank you very much.